which city would you like to settle in?
Bombay.
Mumbai?
Yeah.
All right. To get a house in Mumbai will take time. Shubhajit is your very good friend.
Yeah.
He is a real estate agent out here. This contract is nothing but a put option contract. You were getting a right to buy. In this put option, you are getting a right to sell. Nifty can fall down. It's a nice analytical tool which I generally use for making my strategies and reading options data.
Hello everyone and welcome back to the channel. In this video, we will be covering about how to calculate profits and losses in put options. In the previous videos, we have covered about derivatives, options and what is put and what is call. You can go through them. But before moving forward, do like, share and subscribe this video with all your trader friends so that we can learn together. And let's get started with this particular topic.
Great, fantastic. So yes, as you already mentioned that we have already covered, the basics of options, what are calls and puts. Now today, before we understand how to calculate profit and losses in put option contract, it is also necessary for us to understand put options in a more deeper manner, right? So I'll first explain you what are put option contracts in further detail, and along with that we will understand how to calculate profit and losses in the put option contracts. Yeah, so before we move further, right, I would like to tell you that very important thing is where will you find data about what are the prices of options, what are the price of calls and puts and all those. So web.strike.money, this particular portal strike, it gives you a nice it's a nice analytical tool which I generally use for making my strategies and reading options data. All right, so I'll come back to this particular website in a while, but let me just open up this whiteboard. All right, now like in this particular example, let's assume, what's your hometown?
Lucknow.
Lucknow. Okay. So let's suppose you have a house in your name in Lucknow. All right. And so this house, okay, in Lucknow, right now is worth how much? Let's say, for example, rupees 1 CR. All right. Now this is in Lucknow. Now you wish to settle in which city would you like to settle in?
Bombay.
Mumbai?
Yeah.
All right. So let's say you want to settle in Mumbai.
Yeah.
And for that, you don't want to keep your house in Lucknow. You want to sell it off. All right. But there is one risk.
Yes.
All right. To get a house in Mumbai will take time.
Yes.
Maybe 6 months. All right. You'll have to shift. And in that 6 months, you cannot, before you shift to Mumbai, you buy a house in Mumbai, you will not be able to sell this house, right? Currently,
Correct.
where you are living in. So what you will do is, the risk is that after 6 months, let's say you move out of Lucknow, you want to sell it out. The risk of this is that the price of the house, which is maybe currently assume at 1 CR right now, what if the price of the house goes down?
Yeah.
That is a risk to you, right? So now you want to manage the risk.
Yes.
Correct. So what do? You will find out some real estate agents somewhere, and let's say Shubhajit is your very good friend.
Yeah.
All right, and he is a dealer, real estate agent out here. So he tells you that, okay, Nimisha, you don't worry. All right, you pay me right now just 10% of this particular house value. Okay, that is comes to around 10 lakh
10
rupees.
lakhs. Yeah.
All right. So he says that you pay me 10% upfront over here. All right. And I promise you that after 6 months, all right, when you want to sell this house, I shall buy it from you. So what he is giving you is, he is giving you a promise. A promise to buy your house.
Okay.
Promise to
Yeah.
buy your house at 1 CR, irrespective of the market price then.
Correct.
Okay. He promises you to buy a house at 1 CR after 6 months when you approach him.
Yes.
All right. So here is your dealer, real estate dealer. All right. So now, Nimisha, you gave money.
Yes.
And bought something.
Yes.
You bought a promise from him. So you are termed as the buyer of this particular contract.
Okay.
And this Mr. Dealer over here, he is considered to be the seller of this particular contract. All right. So this particular contract, what does it mean? This contract is nothing but a put option contract.
Okay.
All right, where the buyer is paying this 10 lakh rupees, which is non-refundable token.
Yes.
In our derivatives world, in this market, this particular token is called as premium, option premium.
Yeah.
All right. So you are paying a premium to the dealer, and in return you are getting a promise. Promise meaning you are getting a right to
Sell.
Absolutely right. In a call option, if you remember, you were getting a right to
to
buy.
buy.
In this put option, you are getting a right to sell.
Sell.
All right. So buyer gets the right, and the seller gets obligated. Now, in this case, he will get
has to
obligated
sell.
to
He has to buy.
Yes.
He has to buy the
In
house.
put option,
Yeah.
the seller is obligated to buy. In call option, the seller is obligated to sell.
Sell.
Did you understand the difference between the call and the
Yeah.
put over here? Correct. Now, this contract is done. All right. Now, let's suppose after 6 months, you get a fantastic opportunity in Mumbai.
Yeah.
Maybe a job, or you start your own venture. All right. And you also bought a house out there, and you want to shift to Mumbai permanently.
Okay.
All right. Now, after 6 months, what could happen to the prices of your house in Lucknow?
It may go up,
Up,
and it may go down.
go down,
also,
or it may remain
the
where
same.
it is.
Yeah.
Okay. So let's assume the prices of house goes down.
Okay.
You had a fear, right? And that's why you entered into this contract.
Contract. Yeah.
So that means you have minimized your risk over here by entering into this contract. This is called as hedging.
Okay. Yeah, minimizing the risk.
Yes.
Yeah.
Huh? So let's say the price of the house. Okay. I don't, please mind my drawing. Okay. Yeah. This price of your house goes down from 1 crore to, let's suppose, 80 lakhs. Okay. There was some bad construction that had happened, which failed, and all because of all those stuff, the real estate prices in your area, it went down. Okay, and the prices went to 80 lakhs. Now what would you do?
I would happily go to the dealer.
Yes, you will go to this dealer over here and say, hey, you had promised me that you will buy the house from me after 6 months. Yeah, this is the contract, put option contract. Now chalo, sell.
Correct.
Now you buy it from me. Yes.
Yes.
So you have a right to sell. He is obligated to buy. So now what will you do? You will sell your house, which is worth 80 lakhs.
Yeah.
Okay. But in return, you will get 1 CR.
Yeah.
Okay. So in this 20 lakh rupees is your profit. Correct?
Yes.
But 10 lakh rupees premium you had already paid to him. So you deduct that. So your net profit is your 10 lakhs.
Yeah.
Correct? And if you look at this dealer, all right. So for this particular dealer, what is the payout for him?
He has to
he
has to buy the house, which is worth
yes,
80 lakhs in 1 crore.
in 1 crore. So that 20 lakh rupees is his loss. But 10 lakh rupees he had taken it from you earlier. So that 10 lakh rupees is his profit. So net to net, he will lose 10 lakh rupees. So your profit is equal to his loss.
Yeah.
What if the price instead of 80 lakhs is it goes down to 70 lakhs?
Then also
Even better.
Yeah.
Yeah. Because the house is worth 70 lakhs. All right. But he still has to pay 1 CR to you for that 70 lakh house. So 30 lakhs. Yeah.
30 would be my profit.
Would be your profit. That is 1 crore minus 70 lakhs. 30 lakhs would be your profit minus 10 lakh rupees premium. So net to net 20 lakh rupees is your profit. And that 20 lakh would be his loss.
Yeah.
So the more the prices of house fall down, your profits will increase. Correct? So you have a chance of having unlimited profit potential. And he has a chance. He does not have a chance. He
only option that is
left. Yes, he has a potential unlimited loss. Correct. But let's suppose the houses of price did not go down. Okay. In fact, it increased after 6 months. Your 1 crore house becomes, let's say, 1 crore 30 lakhs. Okay. In this case, would you go to this particular dealer?
No.
No, or else, and of course not with this particular contract, right? As it is, you have a right to buy it. You have a right to sell your house at 1 CR. So in the market, if it is 1.3 CR,
Yeah, I
you
will
would
not go to him.
exactly.
Yeah.
You will happily give away this 10 lakh rupees premium and let it go.
Yes.
So that 10 lakh rupees premium that you let it go, that 10 lakh rupees is your loss.
Loss.
Okay. And dealer would be happy to keep this 10 lakh rupees and that will be his profit.
Profit. Yeah.
So wherever the prices goes up, how much ever the prices goes up, your loss is limited up to only the
Premium
premium
that,
paid.
I
That
have
is 10
paid.
lakhs. And that is exactly the profit of this particular dealer.
Hmm.
His maximum profit from this particular contract will be 10 lakh rupees. But has a chance of unlimited loss.
Correct.
Correct. So now, when would you really go to the dealer to exercise?
When the price of my house has gone down?
Gone down by how much? By at least, 1 crore minus 10
Minus
lakhs.
10
So by at least 90 lakhs. So if the price of the house goes down by 90 lakhs also, no, what will happen is that your house, you are selling it at 90 lakhs. The worth is 90 lakhs, but you are getting 1 crore.
CR.
So from here, your profit is only 10 lakhs. And this 10 lakh premium you have given, that is minus. So you are at break even. No profit, no loss.
Correct.
So you would be happy to exercise your contract, okay, and go to the dealer if the price of the house falls down by this particular value, 1 crore. This is nothing but it is called as strike price. Yeah, it's not about web.strike.money. All right. This is the strike price. It's a lingo, market lingo.
Okay.
So if the price of the house falls below the strike price plus the premium of 10 lakhs, that is 1 crore minus 90.
Minus 90.
Minus 10 lakhs.
10 lakhs. Yeah,
that is
premium
90
10.
lakhs. So only then you would make a profit on it. Clear?
Yeah.
So that's about the put option. Now let me show you some real examples using this particular portal out here. So in this particular portal, you can see that there is strike price I just mentioned.
Yeah.
So instead of house, you now look at, let's say, Nifty. All right. Now your view is that Nifty can fall down.
Yeah.
All right. For whatever reasons it is, you have a view that Nifty can fall down. All right, from current levels. So if the current level is 23,400, okay, and their put price is around 150 rupees. I'm just rounding it off. So when you expect that markets from 23,400, it falls below 23,250 levels. Okay, that is how much? 23,400 minus 153. All right. Only then it will make sense for you to buy this particular put option.
Yes.
And of course, if you go wrong, the market does not go down. It remains where it is, or it bounces back. What will be your maximum loss? Your maximum loss will be 153 rupees. Right?
Yes.
So like this, you can also look at other stocks which are the underlying asset. All right. These are the some put options.
Okay.
All right.
Yeah.
So I hope I tried to explain you in a very simple language. I hope you have understood it.
Yes, that
Yes.
was a very nice and a fantastic explanation that I've got.
Okay.
And I believe that the viewers have also learned a lot. What have you learned and what made you quite interesting into this video? Let us know in the comments. Like, share and subscribe this video to all your traders and investors friends who are starting their journey. Also, do not forget to try out our website, that is web.strike.money. It will be really helpful for everyone who is starting their trading journey.